The debasement trade that was all the rage 6 months ago has come under pressure recently as the price of oil, natural gas, corn, wheat, gold, silver, copper, and many others have come under pressure and have fallen as the dollar has risen. And we're going to talk about this today because in many ways, this is central to all the work that we have done over the last 6, 7, 8 years in trying to explain to people the mechanics of the dollar system and why it is important to understand those mechanics of the dollar system. We actually did a show 6 months ago in December called Why the Debasement Trade Could Fail First. Not because we disagree with the debasement trade, but the mechanics of the system mean it's not as easy as many people otherwise think it could be. And so we're going to revisit the topic this week, and I'm going to walk through why I think this is so important. I would encourage anybody who's not familiar with this concept to kind of look it up and even go back and watch that original show that we did back in December. I think it was December 21st. And check that out as a precursor to this. But if you want to just jump into this is fine too. And so essentially it's not that we disagree with the debasement trade. In many ways, we very much agree with the debasement trade. If you look back, if you zoom out and just look at asset prices over a long period of time, whether it's 10, 20, 30, 40, 50, even 100 years, asset prices go up and to the right. Now, there's a few reasons for that. Number one, more people are born, more people come into the world. There's more people scrambling for the goods that exist, and that pushes prices higher. That's one reason. Another reason is that humans become more innovative and they advance technologically, and that has the effect of making things more efficient, and that can push profits higher and prices higher. The other reason that asset prices go up and to the right over long periods of time is because fiat currency loses value over time. That is a known thing. Governments like that fiat currency loses value over time. That's not a failure of fiat. It's actually a success of fiat. Because if governments wanted a currency that did not lose value or at least held its value over time better than fiat, they would just use gold. But they don't want to use gold. They want to use fiat because that helps them. But that is another reason why asset prices go up and to the right over long periods of time. And so that is this whole idea of debasement, asset prices going up and to the right, fiat currencies losing value, but also needing to understand the mechanics of the system and why it makes it harder than just placing dollars into assets and letting them appreciate otherwise would be, because this doesn't happen in a straight line. And a lot of the work that I have done has been try to explain why this doesn't happen in a straight line. So let's revisit this whole debasement trade. And basically all we're saying is the debasement trade is not wrong. It's just not easy, right? And like I said earlier, gold, silver, copper, crude oil, even the soft commodities have been hit recently, while the dollar that everybody 6 months ago, again, believed was going to, back into the 80s or the 70s, just broke out to a 13-month high. And this just shows what can happen when the debasement trade goes against you for a short period of time. Now, I have no doubts that over the next several years, the dollar is going to lose more purchasing power than it already has. But when the dollar index rises versus foreign currencies, it does matter, and it has implications for asset prices. And so this is why we say, 6 months ago, we said that it's not that the debasement trade is wrong. It's just that it never plays out in a straight line. And the last 6 months have kind of proven this point, or let's just call it the last 3 or 4 months, maybe not the last 6 months. And so, if we take the debasement thesis, our core claim is that it's right, but that it's not easy. Fiat erodes, hard assets endure. Everybody should own gold. Everybody should have an allocation to hard assets. Commodities, I think, will go much higher in the years ahead. So the direction itself was never the argument, but the path was. And the path, for most people in the world, the path does matter. Now, if the path doesn't matter to you, if you have the ability to just have a second source of income, and have a secure source of liquidity, you never ever have to tap your portfolio or your reserves, then you can just go buy gold, sit on a mountaintop for the next 10 years and come back, and it'll probably be higher. But if that's not you, but if that is you, consider yourself very lucky. But if that's not you, then it's important to understand the mechanics of the system, because the mechanics of this system explain why it doesn't happen in a straight line. So again, fiat eroding is not that's not in dispute, and this recent sell-off in different commodities does not change that. But credit contractions are a feature or a characteristic of a debt-based monetary system, and that is what we have. And as a result, carry trades, where money is loaned into existence and then tried to place in some kind of an economic activity that can outperform the carry or the cost of capital or the interest rate, that is the system that we live in. And carry trades get unwound when credit contractions take place. And when credit contractions take place, the debasement trade can get at a minimum delayed, if not completely derailed. And so the debasement trade can be right over a decade or 2 decades or 3 decades, but it can be absolutely brutal for a quarter or two or a year or two. And if you're not careful, that quarter or two or a year or two can totally wipe you out, or at least put you in such a hole that it's really, really hard to dig out of. And our work has largely been on how you can use the dollar and why it's important to understand the dollar and the movements of the dollar to help understand where we're at in the cycle and what could potentially happen to the debasement trade, or to the fact that asset prices go up over time. And this has been my point all the time. Relative levels of fiat currency do matter. Now, if they don't matter to you, again, consider yourself very lucky. But if you're not interested in relative levels of fiat currency, then don't pretend that you're interested in macro, right? Don't pretend that you're interested in politics. Don't pretend that you're interested in capital markets. Don't pretend that you're interested in geopolitics. Because if you're interested in any of those things, then the dollar is one of the most important factor in all of those. And the fact that the dollar doesn't lose purchasing power in a straight line is even more important. And so that's why we're going to go over this a little bit again today. But again, this is just a chart of the dollar over the last year. You can see again here, kind of in late February, it was at its low, and many people were again saying, this is it, it's going down, it's going to go into the 80s, it's never going to come back up. Everybody was shorting the dollar. And again, selling the dollar and investing abroad was again the trade of the year. Many banks and analysts had the low 90s or the high 80s as their target price for the dollar index. And the dollar turned around and went to its 13-month high over the subsequent 4 months. And that's where we sit today. I think it closed a little over 101 on Friday. So let's talk about the dollar. Again, everybody was short it, and instead it broke out. So why does the dollar keep doing this? Again, my work is largely centered on, why does the dollar keep rallying, even though everybody says it's going to fail, even though they constantly do monetary policy that you would think would cause it to fall? Why does it continue to rally, even though central banks print money and it's just paper and there's nothing back in it? And it's really important to understand why it does. And when it goes up against foreign currencies, that is a big deal for asset prices. So from a 4-year low just a year ago, the dollar is now reversed and it's back above its 50-day moving average, 100-day moving average, and 200-day moving average. And this is going on while inflation is ticking up again. And so again, some people have said, we're going to have inflation, therefore the dollar index must fall. No, the dollar index can rise while we have inflation. If you have any doubts about this, just go back to 2022. So, again, just because you heard something or read it on the internet doesn't mean it's true. And by the way, you can say that same thing about me. Just because I'm saying it doesn't make it true, but you can go back and look at the actual numbers and confirm this stuff for yourself. And that's what I would encourage you to do. So here we are, at 101, even though Goldman, JP Morgan, and many others were calling for the low 90s. And now, despite everybody saying that we were going to have all these rate cuts because Trump was coming into power and that's what he wanted, half of the Federal Open Market Committee thinks that we're going to have rate hikes. Now, again, I don't know if we're going to have hikes or not. To be honest, I don't really care whether we do or not. The point is that things do not go in a straight line, and it's important to understand why they don't. Markets do not go in a straight line, and it's important to understand why they don't. So let's talk about gold now, because gold and silver were probably the two most important or biggest beneficiaries of the quote unquote debasement trade. The fact that dollar was only going to lose purchasing power going forward. It went on this huge run last year, and it was destined to continue. And I think everybody knows it went above 5,000. It printed at like 5,500, 5,600 back in January. And, since then, though, we've had a couple good jobs numbers. The dollar has started to rise. We've had the conflict in Iran. And despite all these predictions, on June 24th, gold closed below $4,000, and it's off about 25, 26, or 28% from the peak to where it traded on June 24th. Now, that's a pretty rough drawdown. Now, I know there's many people out there saying, yes, Brent, but I bought at $800. I bought at $1,800. I bought at $2,600. I bought at $3,000. This is no big deal. That is true if you bought at those prices. But there's a lot of people who started to get interested in gold and silver and the debasement trade late last fall, earlier this year, in the first quarter of this year, when everything was at its highs and many of the analysts were predicting that they were going to continue to go higher. And the reason that they got interested is because most people were telling them this debasement trade is a sure thing. It only goes one way. Fiat currency only loses value. And so some people didn't buy at $18 silver or $38 silver or $48 silver. Some people bought at $90, and some people bought at $100. Some people bought at $75. Some people bought gold at $4,800. Some people bought gold at $5,500. Some people bought gold at $3,800. So, but my point is, not if this doesn't apply to you, that's fine. But it does apply to a lot of people. And this is why it's important to understand the dynamics, because anybody that's down 28%, or even if you're down 15%, and I know this from experience, everybody says they're a long-term investor until they look at their statement and they're down 15 or 20%. And all of a sudden, that long-term investor status starts to worry, and it starts to change things, and it starts to impact them. And perhaps they bit off a little bit more than they could chew. They didn't dollar cost average in. So my point is a 28% drawdown is a hard drawdown for anybody, regardless of what they tell you. And so let's go on to the next one here. And this is, I think, important to think. This is an important thing to understand with the rise of gold as a reserve asset. Now, gold has always been a reserve asset, but it's also been very popularized in the last year that as a percent of central bank reserves, gold has overtaken treasuries in the last 12 months. And that's largely due to central banks purchasing it post-COVID and post-United States freezing Russian reserves. It also has to do with the fact that treasury bonds have lost value while interest rates have gone higher. And it has to do with the fact that the price of gold has more than doubled over the last year. So you combine all those things, and gold is now a bigger central bank reserve than treasuries. So why did gold fall during the Iran conflict? Well, this is a direct result of gold being a reserve and the fact that the world still runs on dollars. Whether you like it or not, the world still runs on dollars. That might change someday, and many people want it to change, and many people are trying to make it change. But as of today, it's not the case. And so you still need dollars to operate on the global stage. So this chart here on the left is the DXY since the start of the Iran war. It's up 3 or 4%. And since the day of the war started, gold is down 25% or whatever it is. So 23, 24, 25%. And many people are saying, well, that doesn't make sense. We've got conflict in the Middle East. Why would they be buying this fiat currency that loses value instead of gold? Well, that's not what's happening. When a crisis breaks out and a liquidity squeeze happens, you need to get liquid in the things that you need to settle with. And that is dollars. The world still settles in dollars. So when a crisis breaks out, what do? If your liquidity starts to dry up, you can go tap your reserves. Well, if gold is now a bigger part of the reserves and gold has doubled in the last, I don't know, 2 years, and treasury bonds are still depressed, the central banks are going to go sell the thing that has gone up a lot because now they have more of it. And so they sell gold to get dollars so that they continue operating on the global stage because at the time, gas prices were higher, oil prices were higher. And so as commodity prices go higher initially as part of the debasement trade, for other countries whose currencies are not the dollar, their prices have gone up even more. So as commodities go higher, if it's more pressure on Americans because it takes more dollars to buy them, it's even more pressure on the rest of the world if the dollar goes up as well, because now they have to buy commodities that are higher priced, but the dollar is higher priced as well. And so, they have to sell their reserves to get the dollars to buy the energy, to buy the food, to buy whatever commodities they need to run their economies on the global market. And then just the simple fact is most commodities trade on the global market in dollars. And so this is a direct result of of gold becoming a bigger part of reserve assets. But this is, as reserves get sold, it's not that they don't like gold. And this is not necessarily a bearish long thing for gold. And so I want to make this clear. This is not an argument against gold. This is just an explanation of why during a crisis, gold gets sold. Often when the crisis is over, and often a crisis is met with more money printing, however you want to describe that phenomenon, that's why gold often goes back faster and recovers faster than most other things, because it is still an incredible asset and it's an incredibly important asset. So as I say this is not a bearish thing for gold. It's just an explanation of why the debasement trade doesn't go in a straight line and why you have to be ready for 20, 30, 40% drawdowns, even though over time, debasement is going to continue. And so again, in a scramble, in a credit crunch, in a liquidity crisis, in a scramble for liquidity, gold gets sold for dollars. And part of the reason is gold is extremely liquid. And it is one of the easiest things to sell. And so at the central bank level. And so that's part of the reason as well. And so this is why when a war erupts or when there's some kind of an energy spike or a commodity spike, everyone needs dollars to operate on the global stage. And so they need more dollars to get those commodities, right? And so this is the paradox, right? The haven actually gets sold into the very crisis it was meant to hedge. And then here's the thing. Gold getting sold in a crisis is not gold failing. Gold getting sold in a crisis is actually gold doing exactly what it's supposed to do. Gold is supposed to provide insurance in some kind of an adverse scenario. The fact that you can sell it in a crisis and get liquid to cover whatever liabilities you have is gold acting as the insurance it is supposed to do. So again, my point is this is not a negative thing for gold, but it does explain why the price of gold can fall during a crisis, and it's why you should understand it, right? A dollar squeeze starts the scramble, and the trade can unwind exactly on the asset that you believed was the safest. And in many ways, it is the safest, but it doesn't mean that the price won't go down in the short term. So that's why gold will often, and listen, this happened in 2008. It happened in 2020. This is not the first time this has happened. So all of the people that tell you that gold will rise in a crisis, it might. I'm not saying that it won't, but it often doesn't. And it often gets initially sold for this exact reason that I'm talking about. Okay. So if we just look at some of the other things, so again, silver's down over 40%, gold's down over 25%, crude's pulled back 20%, copper's down 8%. So the point, this is not just a gold thing. It's not just a silver thing. The point is that, all of these different commodities come under pressure, even though these are all hard assets. These are all things that you should probably own, and these all have a place in a portfolio. It's just understanding the mechanics of the system that can cause this to happen. Because if you went all in on silver when it was at $88 because somebody told you that fiat currency loses value and this is a one-way ticket to $300, then you're down pretty severely. And now you've got to hold on for dear life, or you've got to liquidate some to pay your bill. So again, you got to be very careful when you go into these things. And I'm not saying you shouldn't do it. You just need to have awareness. And this episode that's going on right now is exactly why I have tried to explain these mechanics so often and so repeatedly. And so, I think silver's the good example because, it is the one. I mean, silver has broken more hearts than any asset in history that I could think of. It's just incredible. And again, this is not a negative call on silver. I'm just trying to explain this thing. So as it went higher, a lot of people were saying this is it. It's a total paradigm shift. The dollar's dead. Trump's going to cut rates. They're going to do all this thing. It's over. But the more that happens and the more people that flood into these assets, when the reversal comes, it makes it even more brutal. And so the bulls just kept getting more and more bullish as silver went up. And some of these people were calling for $300 by summer. And of course, now they'll say they never said it, but they did say it. And there's proof that they said it. So anyway, but the reality is rather than going to 300, it's below $60 and it might go lower. I don't know. Maybe, everything's pretty oversold now. Gold and silver are probably due for a bounce here because it's gotten so oversold. But the point is, we don't know exactly where it's at. And everybody who said they understood the market and they knew where it was going and this is a one-way trade, were completely wrong. And so, and this is part of the mechanics of the system. And part of the mechanics have to do with liquidity, right? As the dollar index rises versus foreign currencies, that makes monetary liquidity tighter. It doesn't necessarily cause a credit contraction, and it doesn't necessarily cause a crisis. And it's not that this is the only factor involved. There's lots of different factors involved in markets. But if the dollar starts to get stronger, that starts to tighten the monetary system. And when commodities are priced in dollars, and then someone needs dollars for cover their liabilities, what gets sold? Commodities. They're priced in dollars and they get sold for dollars. And so the same flows that powered the trade to the upside can now work to the downside. When you don't want dollars because it's going to lose value and the debasement trade is in full swing, that can push asset prices higher. But when the mechanics of the system make it turn, then everybody needs dollars, and that same phenomena can work in reverse and can cause those commodity prices to get sold. And that's why you often see in commodity prices, they will go up over a long period of time at a relatively slow rate, but then it's like the stairway up and the elevator down, right? It just, you get these long moves up and then you gap down. And part of it is because of the liquidity that is needed when these commodities get sold. And so you can kind of think as the dollar index as a liquidity valve or a weather vane. And this is why I tell people, it's not that you're not investing in the DXY. The whole dollar milkshake theory has never said to invest in the dollar. It's to understand the dollar and what the dollar is telling you. And, and the reality is that when the whole world funds itself in dollars, which they do, as the dollar gets higher, those debts get harder to service, and then you can get into a position where the world is scrambling for dollars, and as they're scrambling for dollars, they have to sell the commodities that were part of the debasement trade, and so you get this reversal again. And I know I'm kind of repeating myself here, but I just think it's really, really important to understand all this. And so, in what the dollar index in many ways decides whether the tape is going to pay you or whether it's going to take money away from you. And part of the reason here is that there's another reason why this DXY index is so important, and it's why the debasement trade does not happen in a straight line. And I don't know that too many people It's not that they don't understand it, or it's not that they don't know it, but I just don't know if they've thought of it in this way. So the whole world runs on a US dollar global carry trade, which means you borrow in dollars and then you try to go invest in something that gets a higher return than the cost of dollars. Okay. The whole world does that. The United States does it and the rest of the world does it. But the rest of the world, not the United States, but the rest of the world also has to deal with their own local carry trade. And what I mean by that is when the United States operates in the domestic market, they use dollars. When they operate on the global market, they use dollars. So they only have to deal with the dollar carry trade. The rest of the world has to deal with two carry trades. They deal with the dollar global trade, dollar carry trade on the global basis, but then they have a local currency carry trade that trades in their local currency, because in their local currency, that money is also loaned into existence. And there's an interest rate associated with that. The reason that's important is because currencies trade relative to each other. So as I remember when I said, when the dollar's getting stronger, that's harder to get over that carry trade. It's harder to service that carry trade. Well, when the dollar starts to fall, that means that the local currency is getting stronger. And so it means that the local carry trade that they're dealing with becomes harder to overcome. And so one of these carry trades, either the local carry trade or the global carry trade, is always going against the foreign countries. Now, where you're at in the cycle kind of depends on which tells you which is the more burdensome, whether it's the dollar carry trade or the local carry trade. But the point is one of them by definition is always going against them. Now, we've actually written a paper recently, and I'll talk about this at the end, that explains this in more detail. And there's a band with which in the dollar index has to trade. And if it stays within that band, the whole world is able to deal with the dollar carry trade, and the whole world is able to deal with the local carry trade. But if you get outside of that band either way, big problems start to happen. You start to have carry trade unwinds, and that is when you get the corrections in the debasement trade. And so if you want to understand when these corrections are coming, or how they can come, or why they come, and the severity with which they can come, you have to understand the dollar. And that's why I've pounded the table on the dollar for as long as I have. Currencies trade relative to each other. One of the two carry trades is always going against the rest of the world, and this cycle decides which one it is. And so this is where we get the trend versus the path. The debasement trade is real. Fiat bleeds, assets win over time. Now, across decades, there's really no question about this, that fiat loses value. Paper losses, paper currency, fiat currency, it loses purchasing power, and real assets compound above it. That's the whole reason we invest in the first place. The reason we invest, rather than putting our money under the bed, under the mattress, is because of inflation and the debasement trade. So the thesis is solid. And this whole thing right here is probably my biggest debate with Peter Schiff. Like, Peter's a friend of mine, and Peter's great. And Peter is right about the long-term prospects of gold. But I always tell him he gets the path wrong because it's not a straight line. And what we're trying to explain today is the path. The path involves brutal drawdowns, because as much as many people want the world to run on gold, it doesn't. It runs on dollars. And so the path means dealing with 20, 30, 40, 50% corrections, full round trips, and long stretches that are long enough to wipe out somebody that either used leverage or had a shorter shot clock than was expected, or just can't wait a decade for the trade to pay off. And so this is why I say that the debasement thesis can be completely right and still ruin the investor if they get in at the wrong time, or if they get in at the wrong side, or if they just don't understand the mechanics. And this is why I say the destination may be certain, but the path is not. And the path holds a lot of danger. And the more you understand the dollar index, the more you understand the dollar mechanics, the less likely you are to get wiped out on the path to your destination. And so, it just, in summary, it's the right thesis. It's not easy. And some of the lessons involved. Fiat still erodes, hard assets win across a full cycle. So buy hard assets, hold on to them. Don't do it with your whole portfolio and don't think that it's easy, right? Nothing in the sell-off breaks the long-term case, but it makes it hard, right? All you have to do is look over the last 3 or 4 months, and this is a very good example. You can look in oil, you can look in gold, you can look in silver, you can look in copper, you can look in wheat, you can look in corn, all of this stuff. It's a very good example to explain this right now. And I'm just going to say this one more time, and I've said this many times in the past. I've probably said it a couple times during this presentation today, but I'm going to say it again because I think it's very, very important. If you think the relative level of the dollar does not matter, you do not understand macro. You do not understand politics. You do not understand geopolitics. You do not understand capital markets. And if you don't care about the relative level of fiat currencies, that's fine. You don't have to. But then don't pretend that you're interested in macro, and don't pretend that you're interested in geopolitics, and don't pretend that you're interested in capital markets. Because if you're interested in any of those things, then you have to understand the dollar index in fiat currencies. And I'll just leave it at that. Anyway, the bottom line is that this is the paradox, right? And I've said this many times: as the dollar rises, that's actually de-dollarization, because that puts pressure on the rest of the world. Defaults happen, debt gets destroyed. When debt gets destroyed, dollars get destroyed, and it increases the desire to get out from under the dollar, and it encourages innovation in something other than the dollar. When the dollar falls, when the DXY falls, that is the re-dollarization of the world, because that is the rest of the world accumulating even more dollar debt, because the only way you get more dollars in the system is to take on more US dollar debt. And so the only way the dollar index falls is when dollar debt is expanding in supply. And so every new dollar that arrives and increases supply increases the amount of dollar liabilities in the world. Increasing dollar liabilities in the world is dollarization. It is not de-dollarization. So a weaker index in the face of larger dollar debt stack onto someone else's balance sheet, and then eventually, when that local carry trade for the foreigners shifts and their currency then starts to fall and the dollar starts to rise again, there's all this new dollar debt that's even bigger than it was before that has to get dealt with. So the point is this system is much more robust than many people believe it to be. And again, you've got to understand these mechanics if you're going to understand what's going on. So I've tried my best to explain this again today. I hope this was helpful. This is really important. This is kind of central to my entire reason for talking about this all the time. I recently wrote the longest paper I've ever written on the dollar. And I talk about the dollar a lot. I don't write about it a whole lot. But we sent out, we just put out this piece a couple of weeks ago. If you go to research.santiagocapital.com, you can find the report, the band there. It explains all of this stuff in much more detail. It's an 80-page report. It explains a lot more than just what we talked about today. There's a number of charts. There's a number of graphs. There's a lot of explanations in there. This is a pro-level report, which is our highest level of research subscription, but we're making this available to everybody who subscribes, either the premium or the pro level. So if you're interested in this topic, if this has been helpful, if you want to understand it even more, and if you want a reference piece that you can put on your shelf or put on your files or put on your desk and refer back to, this is my best effort to explain why this system is so much more robust than many people have previously understood, and why the dollar is not going away anytime soon, and why I'm not surprised at all that we see the dollar back above 100 when many people told me it was going away for good this time. Anyway, that's it for this week. Hope you guys all have a great weekend. We'll be back again next week, and until then, take it easy.